Welcome, everybody. I'm glad to virtually see you all. Hopefully, you're all doing well. Being able to manage through this incredibly difficult and uncertain time. And along those lines, I'm very happy to welcome to the stage with me Mark Finley and Matt Portillo. Matt is with Tudor Pickering Holt. Mark, of course, is with the Baker Institute. Their bios are available on the website, so feel free to check them out if you're looking for a little bit more information. But today we're going to really kind of talk about the future of shale. This has been a subject that seemed to have a life for the last couple of years, actually. And I think the conversation really took a turn when the demand destruction that COVID has wrought really began to be realized. We've seen some pretty significant declines in the United States in particular, focused on shale. And it's left people wondering what the future holds. We've, of course, been through dips before. And as I think both our speakers will attest to, shale proved to be pretty resilient in the past. And one of the things we're going to try to dig into is against that historical context, what the future might hold with regard to shale, what potentials are out there for resiliency to yet again re-exert itself. So with that, I'm going to stop and hand it over to Mark. Real quickly, though, as you have questions, you don't have to wait until the remarks are over. There is a Q&A button up at the top right of your screen. Please feel free to click on that and enter questions as you have them. And I will circle back through them once both Mark and Matt have made their opening remarks and we enter into a Q&A and just general conversation. So with that, Mark, I'll hand it over to you.
Great. Thank you very much, Ken. It's great to be back. And I look forward to a conversation with you and Matt about this. And you're right. It's never a dull moment in the world of energy, and shale and the U.S. shale patch has been right in the center of it. I guess there's, good questions to ask about, well, having been through this before, is this time different? And sneak preview, I think, my answer is yeah. So what I'm going to do is give a little bit of a history lesson, and then, spend a few minutes on where we are now, what are some of the key issues going forward, and then, hint at what it means for the longer term. But I want to leave some of that maybe for Matt and for the conversation as well. I mean, you all know this is not the first time the U.S. shale patch has taken a hit. Most recently, on Thanksgiving Day 2014, OPEC declined to cut production to make room for shale, preferring a price war to reassert what they perceived to be their competitive advantage. Many observers felt at the time that U.S. shale required high prices, and for most of 2014, prices, remember, had averaged $100 and had been nearly $100 since 2011, so 4 years running. The prevailing sentiment was that prices much below $80 would spell doom for the U.S. shale patch. And at first, it looked like OPEC would succeed. After that Thanksgiving Day OPEC meeting, prices fell to about $50, and the U.S. rig count fell by 60% by the middle of 2015. But something was wrong. U.S. production didn't fall. It took another downward leg in prices in the back half of 2015 and into 2016 to get a supply response. Prices fell as low as about $30 in early 2016. The rig count here in the U.S. fell by another 50%. And finally, by the middle of 2016, U.S. crude production from its peak had fallen by about 1 million barrels a day. But by that time, the damage was done. With little recovery in sight or a prospect thereof, OPEC threw in the towel in the end of 2016, going back into production cutting mode to boost prices, essentially admitting defeat of the market share strategy. And they've been there ever since, even bringing in key non-OPEC players like Russia to help share the pain of production cuts. The resilience of the U.S. shale patch back then shocked the world, and that's not an understatement. How did it happen? Matt will have all the details, but in a nutshell, it was competition and innovation, themes that we've discussed in previous webinars. Let me take 3 dimensions of that in particular. First, cost cutting. Cost cutting was massive at that time. Rig rates fell, day rates, staffing, you name it. And many of you lived through it. Additionally, However, the industry was still able to access capital markets, albeit at greatly reduced activity levels. And again, Matt, I think, will describe some of this in more detail. To me, one of the keys was productivity gains, which were massive. Between the price collapse and the end of 2017, data from the Energy Department's drilling productivity report shows that per rig oil production or productivity nearly doubled in the Eagle Ford, more than doubled in the Bakken, and nearly tripled in the Permian. Lots of ways this was accomplished: faster drilling, pads, longer laterals, better fracturing and completion techniques. Again, but the bottom line was massive gains in productivity, along with cost cutting and the ability to continue to access capital markets, allowed the U.S. shale industry to stay competitive at lower prices, at much lower prices. Indeed, by 2018, so rolling forward just a couple of years, oil prices improved a bit, but they were still way below the pre-price war levels. They averaged about $65 in 2018. In that year, U.S. crude production, driven by shale, had the biggest one-year increase of any country ever in the history of the planet, growing by 1.6 million barrels a day. And that's not counting nearly 600,000 barrels a day of growth from NGLs as well. Now let's fast forward to today. As we've discussed in previous webinars, the COVID-19 pandemic is causing this year the biggest ever drop in global oil demand. DOE this week estimated that the decline this year would be over 8 million barrels per day. And you all know what's happened to prices. At first, a standoff between Saudi Arabia and Russia actually made things worse. And you all know that U.S. prices famously, although briefly, fell below zero for the first time ever. The OPEC Plus group, including Russia, subsequently agreed on the biggest coordinated production cuts ever, aided by a timely push from President Trump. But tensions remain in the group. Russia, in particular, has been very clear that it does not want to lose market share again to U.S. shale producers. The reality is they didn't need to worry. The U.S. supply response has been massive. Here in the U.S., the oil rig count fell by 75% in 4 months. That's a much faster and bigger reaction than we saw last time. Moreover, with negative prices forcing a number of existing wells to shut in, U.S. production saw the biggest and fastest decline on record, with lower 48 crude production falling by almost 2.5 million barrels a day in 2 months from March to May. Now, much of that shut-in production has come back online as prices have recovered, but the underlying decline rate as U.S. production has gotten bigger, the underlying decline rate of U.S. production base has also gotten bigger. Heading into the crisis, it was well over 500,000 barrels a day every month. And as a result, today's weekly estimate of U.S. production from the U.S. Energy Department shows crude production right now is 3 million barrels a day below pre-pandemic levels. And that's a bigger decline than we've seen from either Saudi Arabia or Russia. So going forward, what are the issues that we have to grapple with, and how do they compare with last time? Let me go back to my checklist. Cost cutting, there's some, but not remotely likely to be at the extent that we saw in 2015 and 2016. The simple fact is there was more fat in the system when oil prices had been $100 for 4 years. This time around, the industry was already under pressure even before the pandemic. On the back of that record growth of U.S. oil production in 2018, prices weakened and the rig count was already declining. In fact, from its peak in 2018, it was down 25% even before the pandemic hit. And service companies and other, supporters of the industry have already been squeezed. So the scope for additional cuts and trimming of the fat is more constrained than it was back then. Next on the checklist, access to capital, brutal. And I think Matt will dwell on this at some length. Many of you are living through it, and you all know the stories. Energy is not the flavor of the month. The sector's share of the U.S. stock market is at record lows. ExxonMobil was removed from the Dow Industrials for the first time in a century. ESG pressures on fossil fuel companies. So again, we'll discuss that in more detail coming up. And finally, productivity. Like costs, there is some improvement, but as the technology has matured, frankly, the pace of learning is not as great as it was 5 years ago. In the 12 months heading into the pandemic, the DOE data shows that per well productivity in the main shale plays grew by around 10%. We can expect some improvement going forward because with pared down activity levels, we're left with the best crews, the best rigs, the best frac spreads, and working only the best prospects. But again, the prospects are for productivity gains to be nothing like the doubling and tripling that we saw in the last price collapse. Right now, we seem to have hit bottom. The rig count's stabilized, frac spreads are growing a bit, but even so, my numbers show that we're nowhere near the levels of activity needed even to stabilize production, given the underlying decline rate of the base. So to me, the key question going forward is, with limited prospects for cost cutting, with greatly restricted access to capital markets, and with modest productivity growth, what price will be needed to double or triple the level of drilling and completions? And stepping back a bit, on the geopolitical front, are Russian and Saudi fears of losing market share to a resilient U.S. shale industry out of date? As the global oil market rebalances, will they be haunted by the ghost of a shale industry that doesn't match today's reality? And what will that mean for global markets, for supply and demand balances, and ultimately for prices? Let me pause there and give Matt a chance to weigh in.
Thanks, Mark, and thanks, Ken and team, for having me. I think you hit on a lot of key points that are very relevant in today's conversations with investors. If you rewind back to 2014 and 2015, I think a lot of the themes that you touched on were very true. The industry had essentially an unlimited amount of access to capital, primarily through equity and debt issuance. These businesses were not self-funding, which is something that has become a big shift in focus from investors on a go-forward perspective. And you did have pretty significant changes around lateral length, proppant intensity, and where you were drilling your assets that did drive productivity enhancement really through 2017. In 2017, things changed pretty significantly for the industry. Investors have had enough with the unending outspend of capital and are pushing management teams towards more sustainable business models, which is a good thing in our view. It will create a healthier macro backdrop over the medium to long term. But in that process, it was a very painful transition. Additionally, as we shifted away from a world that was very dominated by net asset value and it was focused on inventory and expanding inventory through downspacing, we actually saw pretty significant degradation of well productivity from 2017 through 2019. And so as producers focus more on generating free cash flow, improving their balance sheets, and actually driving improved well level rates of return, the trade-off is actually upspacing and reducing their inventory profile going forward, which actually plays well into a world that doesn't need as much growth. And so there are a lot of things that have really changed, and we can unpack that in the Q&A side of this over the next 50 minutes or so. Happy to touch on a lot of these topics, but it is, I think, a very different world. The last thing I would say is shale is a mature business. In 2005, it was really about the shale revolution. Today, it's about shale evolution. And a big part of that is that a lot of these basins are reaching maturation. If you look at one of the more established oil plays in the U.S., the Bakken, we forecast only 6 to 7 years left of tier one inventory left to develop. And at these commodity prices, those wells are barely economic. And so the real question I think also comes out of this is, what oil prices do producers need to generate a healthy and sustainable business model while at least maintaining production and potentially over the medium term driving very minimal amounts of growth? So I'll pause there and maybe turn it over to Ken if we want to go into the Q&A discussion.
Sure. Great. Thanks, Matt. Thanks, Mark. Very well said in both cases. We do have quite a few questions coming in, and there is one that I'll just address right up front from one of our students here at Rice, specifically asking about job prospects in the oil and gas patch, given everything that's going on. I will just say that I don't think we're really going to dig into that here, but never fear. We are in the process of planning a webinar much like this in one of our weeklies where we discuss the future of employment in the oil and gas sector. So hopefully your question can wait until we actually do have that webinar because we'll have some experts on that can address that very, very succinctly. So moving beyond that, one of the questions actually that I want to ask before we get into some of the things that have come across the Q&A, Matt, you just raised something that was interesting before. You said before it was about the shale revolution, now it's about shale evolution. And I wonder if you can kind of dig into that a little bit more. Specifically, what does it mean for ultimately production in North America, but more generally industry structure, how investors approach the sector. And then we can kind of expand on that, Mark, and maybe you can jump in and talk a little bit about what that might mean for the U.S. position in global oil and gas markets.
Sure. I think one of the most exciting things that took off in 2005 was really the revolution of the shale business model, which was started out in gas basins. You started out in plays like the Barnett, the Fayetteville, ultimately transitioned to the Haynesville and the Marcellus. And what was interesting about that is as each new play popped up, generally every 2 years, investors found that the cost curve in the U.S. was shifting very dramatically. The resource base was shifting very dramatically. But in that process, what you essentially did was capitalize companies as these plays were discovered to develop the resource. And every 2 years, you moved on to a new, bigger, and better play. And the Marcellus really became the 800-pound gorilla on the gas side, and that became established in 2009, 2010. And really the other basins where you had deployed a lot of capital faded from existence. But you still had a lot of companies that had been capitalized on the back of that resource potential in the market. And so they then went out and proliferated exploration in other basins, and you saw this in oily plays like the Bakken, then the Eagle Ford, and then the Permian. And the Permian became kind of the king or queen of the oil market in the U.S. And essentially through that process, you capitalized a tremendous number of public and private companies developing that resource. So you created a very diverse industry, but a very fragmented industry. And the industry itself was very in need of capital coming from the equity capital markets as well as debt capital markets. It isn't a self-financing business when you start from 0 to 60. And that played a big role until about 2014. And then in 2014, as we had the first downturn, we started to go through Chapter 11 processes. I think investors realized that a lot of the major basins were well-defined. The aerial extent of the plays was pretty well known. The depth and delineation of the horizons was pretty well known. And I think the view was from that point forward, we're no longer really in exploration mode. We're shifting to development mode. But through that 14 and 15 downturn, companies had put themselves into a position from a balance sheet and leverage perspective that was untenable. Generally, most of the companies that we covered coming into the downturn in a $80 to $100 commodity price environment had 2 to 3 turns leverage on a net debt to EBITDA perspective. And in a commodity business like that, that is not a healthy position to be. And so where has that mindset evolved? I think one, industry consolidation is becoming paramount. Most investors we talk to, and quite frankly, I think most industry participants feel like each of the major plays in the U.S., with the exception of the Permian and potentially the Marcellus, only need 1 or 2 champions. And that really comes down to scale. Those basins are at the point where they're actually peaking on maturation and potentially rolling over. And in that world, it's all about cost and scale going forward. And so industry consolidation is a big topic. 2, I think as investors look at the sector in general, the market cap of a lot of these companies has faded to a point where they're just not relevant. And investors are looking for companies to essentially consolidate down to create more market cap, to create healthier companies, and ultimately to work through some of the G&A leverage that a lot of these management teams have. And then 3, the business models are changing in a big way. And this is kind of the final point I'll make here. If you look at the Q2 conference calls for the vast majority of the companies that we cover, which represent about 60% of all the rigs running in the U.S., the industry has changed the way that its business is going to be run. And it kind of kicked off in 2018 when equity investors said no more equity. And then the debt market seized up in 2019. Even before COVID, there was a big bifurcation. And investors are basically pushing management teams to first and foremost reduce leverage, secondarily set guideposts around capital reinvestment. And so most management teams are now committed, regardless of the commodity price cycle, to only invest 70 to 80% of cash flow. That is going to limit growth. But I think the most important thing that's come out of conversations with the industry this year is a cap on growth going forward. And E&Ps are committing, regardless of the upside in the commodity, to effectively capping their growth rate at a 5% level going forward, which is going to have profound implications on the U.S. If you look at our macro model in 2021 for the U.S., we expect essentially the entire industry to move towards a maintenance capital scenario in a $40 to $45 commodity price environment, which is essentially holding production flat exit to exit. But beyond that, we're looking at about a 3 to 4% growth rate on a CAGR perspective. A lot of balance sheets are still in really bad shape. And as the industry consolidates down, growth is less of a focus. Free cash flow generation is more of a focus. And so we see the U.S. only growing about 3 to 400,000 barrels a day on average from 2022 through 2025. So it is very unlikely, in our view, on the current commodity price forecast that we're thinking through, which is a $50 to $60 WTI world, that we will reach the peaks we saw prior to this at about 13 million barrels. And that has pretty profound implications to the macro environment as you think about the global balances and dynamics as we move forward over the next few years.
Yeah, so real quickly, I know Mark has a question for you, but I just want to ask you this real quickly. In terms of everything you just laid out with regard to capital discipline, effectively, and the stress that the industry is undergoing right now, do you have any thoughts about how many different types of operators might be active in the next 5 years in the U.S. shale patch?
I think the view, and another interesting dynamic is the private equity business model effectively kind of fell apart. So if you look back to kind of the private equity strategy in shale, it was a fantastic business until about 2016, 2017. And the reason being, you went out, you hired a team, you capitalized the asset, you bought resource, you drilled a number of wells, you created a production profile, and then you turned it and sold it to a public company. In a world where public investors are not interested in an acreage transaction and you're generally only interested in a production or cash flow transaction, those private equity business models don't work. So we've seen a significant consolidation already on the private equity side, and private equity investors in general have moved away from the upstream sector. That is a big component of part of the wedge that was basically in the system up until the 2017, 2018 timeframe. On the public side, we've seen a big strategy shift. Public companies in 2016, 2017 were paying high acreage premiums. So in the Permian, you were paying $30,000 to $50,000 an acre to buy undeveloped land. That was putting stress on the system from a balance sheet and a return profile perspective. We've now figured out the right formula. And the formula on the public side is basically mergers of equals. And you've seen a number of these transactions that have occurred where effectively it's an equity for equity swap. The two companies come out healthier on the other side, and investors are pushing for it, and investors are very open for it. And so generally, to your original question, where do we think this ends up? We generally think we're probably going to end up with somewhere between 10 and 15 large public companies left in the sector, and potentially 4 or 5 kind of mid-cap E&Ps that give a little bit of exposure to different basins. But beyond that, we just don't see investor appetite or public equity interest in really capitalizing companies beyond those levels, which is a pretty significant sea change on the public side from where we were 2-3 years ago at 50 to 60 reasonably sized E&P. So there's a very good chance that we see industry consolidation take down 60 to 80% of the companies that we think about from a coverage standpoint.
Sure. Mark, I think you indicated you had a question.
I did, and as somebody who's been around this patch for a long time, in my mind, this is an industry of optimists. And with a can-do attitude, no one ever tries to drill a dry hole. Everyone thinks that their project is going to work, and so my question is, everyone talks about being disciplined on the downside of the cycle, but history says, yeah, right, human nature being what it is, on the upside of the cycle, people are still going to get excited. They're still going to find ways to spend money. They're still going to find ways to drill. So I'd really be interested, Matt, in why you think that this time around we've beaten human nature, and we'll be more disciplined on the upside.
I 100% agree with you. I mean, that is still the major fear for investors and industry as a whole is somebody's going to break rank. And the second they break rank, the rest of the industry follows. I think the really interesting part of this conversation that has come to the forefront that hadn't existed 3-4 years ago is core inventory depletion in the US. And as public companies have had to go seek capital, or as they've gone out and done acquisitions, the justification for a lot of these deals, whether it's a merger or whether it was an acreage transaction in the past, was that their core inventory in their legacy basins was depleting down. And so I think one thing that has become readily apparent when you look at plays like the Bakken, when you look at plays like the Eagle Ford, and even when you look at areas of the Permian, we are in a period where if you accelerate the drill bit meaningfully from here, you're going to pull that inventory profile down to 5 or 6 years. And if you get into that situation, you either have to start to drill tier 2 rock, which tends to have a cost structure that's $10 to $20 higher than your break evens on your tier 1 rock, or you're going to have to go out and be more acquisitive again. And so there is little public incentive, given the equity performance today, to go out and grow. I think there's little public incentive, given balance sheets and how stretched the vast majority of balance sheets are in the industry right now, to go out and grow for the next few years. But really, it comes down to the rock and the resource. And, this has been a fantastic boom from a growth perspective in the US. But we're hitting that maturation phase. And when that becomes a reality in the next 5 or 6 years, I think industry participants are better off. And I think this is something we're hearing from most of the management teams we talk about, going to a maintenance capital scenario, lowering your base decline rate, and potentially preparing for something that is very topical with investor and public companies alike, which is energy transition and the terminal value risk on crude demand over the next 10 years. And setting your business up with a low cost structure and a lower decline rate, because shale has major decline issues, is a more feasible outcome than returning to growth and potentially hitting a wall 5 to 10 years down the road.
So thanks for that, Matt. That's actually very insightful. Mark, I want to kind of pull on some of the threads that Matt's laid out and maybe get you to comment from a sort of much bigger picture perspective, thinking about what the evolution of the shale sector, as it's been described now, means for the U.S. position in the global landscape. And how that actually plays against Saudi, Russia, emerging demands, or even emerging markets and new supplies in different places around the world.
Mm-hmm. Well, as always, the answer is it depends. I mean, what I think I heard from Matt was a expectation that U.S. production would have a modest recovery beyond 2021, but kind of getting back to the previous peak. And then after that, what I heard was a struggle even to maintain, without a significant ramp up in prices. So if that's the case, I mean, at 13 million barrels a day ish, at the peak, the United States was just self-sufficient. I mean, the United States, broke its pattern of being import dependent for 70 years for a couple of months. Before the crisis hit. Depending on where we are in the data, I'm waving my hand over here because that's my other screen. Sorry. Depending on the week where we are with the data, the timing of the U.S. production decline versus the demand decline, the United States is roughly balanced now. Does not sound like a scenario in which the United States significantly ramps up its oil exports. By the way, we haven't talked about natural gas at all, so that might be a fun thing to go back to.
It's coming, believe me.
So on the one hand, the United States at current production levels would remain the biggest oil, at pre-crisis levels, remain the biggest oil producer in the world. But being the biggest producer doesn't necessarily mean being the most influential, because that comes through trade. And in that, by that metric, a self-sufficient United States is still game-changing from a national security and strategic perspective, but it doesn't transition us into being a major exporter with all of the different changes in geopolitics that would come with that.
Sure. So thinking, I'm gonna kind of pull on that just a little bit. Believe me, we're going to come back to natural gas because there's actually quite a few questions that have come through, and I have some. So would love to get your thoughts on that front. But thinking about U.S. shale sort of in a bubble is kind of a misnomer when you think about overall global oil market balance, because there are lots of other supplies, some of which have been handicapped significantly in the current price environment. And I guess it sort of begs the question, just thinking about North America more generally and the massive amount of resource that exists in our northern neighbors' lands, right, in Canada. What do you think the outlook, the picture that you sort of painted in, say, a $50 to $60 world with modest production growth, basically maintenance levels of production in the U.S., what do you think that means for the prospects for Canadian crude production and sort of how that might actually impact the North American balance, if you will? So either one of you can pick up that and offer some comments. I'm happy with that.
I can comment on it. We're seeing pretty similar trends in the Canadian market. Our Canadian research team covers the Canadian seniors as well as a number of the Canadian SMID caps. And it's kind of a similar situation. Canada's actually been going through these growing pains for quite some time. It really kind of kicked off in 2015. And I think one of the biggest concerns on the public side in the US is that we go through that derating of valuation, where essentially because you end up in a scenario where infrastructure is constrained, companies are effectively repriced towards higher free cash flow yields. And that has occurred in Canada, and it's essentially pushed a lot of the Canadian upstream industry to move away from growth because you're not being effectively rewarded for any growth. And so Canada has stagnated from that perspective outside of a few large projects. It's a pretty attractive landscape in a $50 to $60 commodity price environment because the Canadian heavy universe does not have the same decline profile as the US. You maintain a much lower maintenance capital number, which means that as your commodity prices rally, your leverage to free cash flow actually accelerates pretty meaningfully. And that margin expansion on the back of those heavy barrels coming into the market is quite significant. So we're not expecting really any material growth out of Canada because it's a pretty similar dynamic. Actually, the Canadian universe has kind of been living with this change in the business model structure for a little bit longer than the US. But I think they're going to come out of this equally as healthy. We're just starting to see M&A pick up in the SMID cap sector. I think investors we talk to would like to see more M&A out of the Canadian market. But it's just a little bit different environment in terms of how things have played out from a change of control provision.
Yeah, I think $50 to $60 world, you probably see that those dynamics playing out in the United States too. That's it feels like it's a long way off. So, but I think the additional complication, for Canadian producers is just access to markets. The production's been bottled up. Opposition to pipelines, east, west, south, are a significant consideration on top of the project economics. I was intrigued by Matt's reference to potential for a future world where decline rates become a bigger issue. In that case, the heavy oil projects in Canada are a big winner because they don't have them, at least not in the way that we have with deep water fields or with shale.
Yeah, I thought that was an interesting point as well, and well taken, actually, because when you get into a discussion about trying to stabilize production, the cost is just different because it's a different level of maintenance capital to keep production at stable levels. I think that's actually a really interesting point. So you asked for it, so I'm going to turn to it. Would love to get both of your perspectives on what this outlook on the oil patch means for natural gas production. And everybody knows that that's been tracking this for the last 20 years, that as the shale revolution unfolded, the U.S. went from a province that was, in the 90s characterized as a gas bubble to the early 2000s, one in which gas was in perpetual decline and gas prices between 2003 and 2006 in the U.S. were higher than anywhere else in the world, and we were going to start importing LNG. And then the shale revolution happened and everything turned upside down. Talk about transitions, right? And what's really interesting to me about gas, and maybe you can weave this into your comments here, is when oil prices collapsed in the second half of '08 into '09, gas prices collapsed right alongside them when the global financial crisis hit. But gas prices didn't recover when oil prices recovered. And what that did is it triggered with increased, commercial incentive to direct drilling towards oil, a lot of associated gas production. And that's really helped to kind of stoke growth in gas output more generally in the United States. And that, of course, then does beg the question, how will gas producers fare in this new world where oil production might actually suffer as we move forward?
Yeah, I'm happy to jump on that. So this is, we hope, the last year that we were going to have a negative forecast for natural gas. We came into the year quite bearish on the fundamentals, which had to do with where the balances were, as well as our concerns that the global market from an LNG perspective was quite oversupplied, given where European inventories were. What we saw was a very significant pullback through the summer on LNG exports. And we've seen a fairly significant decline in the U.S. in aggregate gas production. So to put this into context, coming into 2020, we were pushing about 96 BCF a day of aggregate gas volume. By the end of this year, on the combination of legacy basin declines, which includes plays like the Pinedale, the Fayetteville, the Barnett, in conjunction with declines in the associated basins, we're going to exit around 89 to 90 BCF a day of supply. And so the market has moved from an imbalanced, weather-adjusted market to a market that is now currently in balance. And then as we head into 2021, on our current forecast, essentially gas production is going to be fairly flat on an exit-to-exit basis. So the puts and takes there, you have associated gas, as I talked about. Oil in our model at 40 to 45 is essentially flat exit-to-exit. Gas producers, uniquely in the U.S., one, it's a very consolidated market. So if you think about the Northeast, about 30 BCF a day of supply, there's about 6 or 7 large producers that control that supply. And most of those E&Ps, even in a 250 to 275 gas world, still have untenable leverage profiles. And so they're going to work through balance sheet repair, in some cases over the next 4 to 5 years, because they have a lot of debt coming due. And in some cases, the debt markets just aren't open for them. So the Northeast is getting into a situation where after in 2009, producing less than a BCF a day, coming into 2020, we're producing 30 BCF a day. So over a 10-year period, we added on average about 3 BCF of supply. The shift in that market dynamic is something that we don't think is priced into the back end of the forward curve. Similarly, one interesting dynamic in the U.S. as well, around the Haynesville, which makes up about 10 BCF a day of aggregate supply. That is a basin that is dominated by primarily privates, and then a few public operators and 2 or 3 integrateds. The integrateds have pulled back significantly on their capital allocation as they have to finance their balance sheets and dividends, and some are shifting to new strategies on energy transition. But really, it's the private business model. So this is something that's been very interesting. When you no longer can build a business around resource capture and flipping that asset to a public company, and you actually have to run the asset for sustainable cash generation, the private equity sponsors behind a lot of the companies that are in the Haynesville are essentially moving towards a dividend distribution model. And in a dividend distribution model or in a free cash flow distribution model, there's not a lot of incentive for growth. The real incentive out of the basin is to generate high margin returns on the wells you're drilling. And kind of similarly, the basin has a very high base decline rate. Those producers are working towards mitigating that decline. So in a $2.75 to $3 gas world, I would not expect over the next few years to see much incremental dry gas production coming out of the Northeast or the Haynesville. Now, to put that into context, though, when you have 40 BCF a day of supply coming out of those two basins, producers don't have a lot of wiggle room to grow. If you get into a situation where every E&P individually raises their hand and says, I would like to grow 4 or 5% per annum, all of a sudden you're pushing somewhere between 1.6 and 2 BCF a day of gas supply into the market. And even under the constrained scenario of associated oil growing 300,000 to 400,000 barrels a day, that adds about a BCF to the supply stack. And so the only reason I bring that up is producers are aware of that. They understand that the reason that gas has partially gone from 13 down to 150 at one point this year was the unending growth and the associated market's impact on that. And I think you're seeing a structural shift, again, behaviorally around the gas markets. Last thing I'd say on this is core inventory, again, is a focus. It's not nearly as pronounced as we see in some of the oil basins, but take Susquehanna County in the Marcellus, for example. That is one of the most prolific portions of rock in the U.S. And under a maintenance capital scenario, essentially very limited growth, the producers that have exposure there only have about 8 or 9 years left of inventory. And they publicly talk about that, and it's part of their strategy, moving towards higher dividend distribution, moving to an ex-growth business model, and essentially changing the way the business has evolved. And I think it kind of comes back to that whole evolution of the shale business model that we've been talking about.
Mm-hmm. Mark, anything to add there?
A few things. I can remember, when oil was $100, having a meeting with the head of my company's U.S. natural gas business and saying, if we're reading this right, you're about to become a very popular guy inside the company, because the oil market is going to head real fast to where the natural gas, because of shale, to already where the North American gas market already is because of shale. And that's kind of what we've been living. I think in addition to the supply side points that Matt raised, I'd raise a few demand side and one midstream point. On the demand side, there's good news and bad news. The bad news is there's still a lot of capacity to switch back and forth between coal and gas and power generation in the United States. And at $3, you're starting to flirt with it and see it. So there's on the demand side, gas has a lot more competition with other fuels, at least in the very short term, than oil does. The good news is there's a global marketplace with that, the U.S. producers can access through LNG. Now, historically, that would have been great because LNG was priced off of oil. As global gas trade grows, we see that disconnecting. And I guess the question is U.S. shale big enough to set a global price? Or is global demand big enough to give the U.S. some uplift in a scenario like that? Because it feels to me, that where we are right now, with all the gas in the world priced at, the equivalent to Henry Hub, that's new. That's a wrinkle that I personally haven't seen before, and I'd have to give more thought to where I think the balance of power lies. The other question is, the final point is on the midstream. We kind of talk about oil versus gas, but really it's that continuum with, the gas liquids that I certainly, as an career oil analyst, always threw in and said, well, that's oil. And historically it would price as oil, but not anymore. And so I think the additional wrinkle is, if we're thinking about associated liquids, we can't just think in terms of a global oil market. We have to think about a specific market for those light end liquids and how it gets priced, which I think is become very clear is not necessarily the same thing.
Sure, I think that's a fair point, and I'll comment real quickly on some of the things you mentioned about gas, and then pull on a thread on that you just also introduced. But on the gas front, I mean, the parity that you've seen in pricing at all the different markets around the world, I very much chalk that up to COVID, right? It's really about demand destruction and really lack of uptake, for a variety of reasons related to shut-ins and people not doing as much, industry not working at the same pace, et cetera, et cetera. And layer into that also the first half of the United States, first half of the year in the United States, we saw, increasing LNG exports, and that was tied directly to the opening of some facilities in the latter half of 2019, beginning of 2020. So, you add a negative demand shock to an additional supply, and that'll very quickly lead to exactly what we saw in the price world. And I think the big question there is what happens coming on the back end of COVID, right? Which of course opens the door to a lot of conversations about energy transition and shifting energy mixes in different places around the world, which I definitely want to get to that in just a minute with both of you. But first, you sort of opened the door for this, Mark, and I would love to get both of your thoughts on this. It is a midstream type question. When we look at a place like the Permian Basin, and I'll just use that as an example, the record of gas flaring is pretty well known. As a lot of the developers out there were really after the oil prize. And that meant that a lot of stuff developed without sufficient takeaway capacity. And there was, quite frankly, very little incentive to develop it, given you could flare and the price for natural gas was so low. So I guess what I'd like for both of you to maybe comment on, and maybe Matt, you jump on this first, is do you see in the sort of evolved shale world a world in which effectively debottlenecking occurs with some new infrastructure being added so that you can actually improve the economics by monetizing that gas rather than flaring it?
Yeah, it's a great question. And particularly for the Delaware Basin and the Permian, gas is a pretty significant chunk of the overall BOEs that are produced. I think the industry, quite frankly, was surprised by the GORs when they first started developing that portion of the play, because the play took off in the Midland, where you're typically looking at an initial oil rate of 70%, and over the life of the well, it moving down to 55%. And so with gas being a portion of that production stream, it really wasn't a huge factor. And so the producers were much more focused on oil margin. Secondarily, as the Delaware took off and it became as significant from a drilling and development standpoint, we just saw extremely prolific oil wells with a tremendous amount of gas drive. And that was the big surprise that pushed, I think, the producers into a situation where they hadn't appropriately planned for infrastructure. And in a pre-ESG world, I think we would have kind of worked our way through this pretty slowly. In a world where ESG has become a hyper-focus, controlling what you can control around emissions is paramount. And you've seen a big intentional change in the way that operators are approaching the business, which is essentially committing to long-haul takeaway out of the Permian, as well as making sure that when you bring on incremental new wells, that they can tie into infrastructure so that you can keep your flaring rate down to minimal levels. And one interesting thing that we're now seeing, if you go out and do a bond deal in the upstream sector today, your ESG report and your ESG team are a big factor in those conversations with debt investors. And you have to check all the right boxes. So that's a pretty significant change. Last thing I'd say on the Permian, I think we're going to be well overpiped as we go into 2021. If you look at the gas side of the basin, just through natural declines this year, the Permian will be under pipeline capacity by Q4, which coming into the year, we were flaring about 700 to 800 million a day of gas. You have a 2 BCF a day pipeline starting up in Q1 of 2021. You have a second 2 BCF a day pipeline starting up in Q3 of 2021. And we just don't see the growth coming out of the basin for any kind of incremental new capacity to really be a bottleneck or constraint. So I think the good thing is on the gas side, the slowdown and this moderation is actually healthy for a lot of reasons for the industry.
Great. Mark, you want to add anything to that?
No, but I actually want, I think it'd be useful for you to talk a bit about some of the work that's going on at the Institute around gas flaring.
Well, yeah, no problem. We actually, last week, as a matter of fact, we had a really interesting webinar, which was interesting for more than one reason. And I actually was on a call with Antoine Half this morning, and we sort of joked about it, but we had a lot of technical difficulties for those of you who were tuned in. But one of the things that really came out of that is the pace at which technology is evolving to actually monitor flaring and methane emissions. So both. And that, from an ESG perspective, is a very, very powerful motivator, to speak to what Matt just mentioned about interactions, particularly for debt capital. So the world is evolving, without a doubt, and it's all part of the umbrella under the energy transition sort of discussion. But one of the things that we are really keenly interested in doing is looking at how flaring and methane have evolved as infrastructure and well development progresses. Because I think that actually it can shine a very powerful light on the appropriate policy vectors to push on, if you will, if you're interested in, for example, eliminating routine flaring. And that in particular has been a huge issue in the state of Texas. As Matt just mentioned, the amount of volume that's been flared is something that is on everybody's radar. And the Railroad Commission at a blue ribbon panel that they put together provide some recommendations on different types of approaches to reducing routine flaring. I think that hearing was in mid-June, if I remember correctly. So there is a lot of parts moving on that front, on the flaring and methane emissions front. The other thing that's really interesting that I just want to comment on that Matt mentioned is there was infrastructure being developed, and then COVID happened, and we saw production declines, and coming out of 2020 and into 2021 being overpiped is a really interesting statement. In many ways, it's sort of like saying, effectively what we've done in 2020 is hit pause and allow infrastructure to catch up with activity. And I wonder, because I don't know the answer, I wonder if we are in a position where we have spare takeaway capacity, so you're not going to need to, spend any capital in the midstream to move stuff, except perhaps for gathering. How that actually will impact well economics, particularly in a world where if we do see, natural gas prices, it's energy efficiency at work right there, where if we see natural gas prices actually do begin to recover a little bit because of the outlook that we just saw up into the $2.75 to $3 world. And, Mark, to your point, I think that might be a reasonable ceiling because the global market will begin to absorb what is not used here if coal starts to displace gas. And so that kind of creates an interesting window where gas might exist for a while, but it's elasticity of substitution at work, basically. But
and you're saying that there's a cyclical dimension of life in the infrastructure sector as well. I'm shocked.
I think that's the punchline. Yeah. So that shouldn't be a surprise to anybody on this. Anybody really follows the sector, but I think it's going to be an interesting space to consider when we think about economic incentives to reduce flaring, particularly as we have enough infrastructure to move gas away from these basins if drilling does begin to recover to any extent. And that's going to be one to watch, and it's certainly one that we're keenly interested in engaging on. So we only have about 8 minutes left on our timeline, and I wanted to touch on the energy transition a little bit. Matt, I know from previous conversations you've been looking at things going on in the transportation sector and what that might actually spell for motor fuel demand, liquid fuel demand in that space. I wonder if you could maybe talk about that a little bit, what you see happening, the pace of change, and how you think that might actually play out in the global market, and then perhaps tie that back to your previous remarks about the evolution of shale.
Sure. This is a big focus for the TPH research team and also the broader TPH banking practice, because we realize, the world is evolving and changing here. And it feels like we kind of hit the tipping point over the last 1 to 2 years that has essentially moved us into a new kind of paradigm around what really is involved with energy, broadly speaking. I think our key takeaway on the auto market is really one that it is going to become a much bigger discussion over the next 10 years. And you're seeing from a policy perspective, whether you look at it in China or whether you look at it in Europe, a big push for electrification of the auto fleet. And Norway is probably the best example of this, although it is a country that can afford to do this. But they have put in initiatives around tax policy that has essentially shifted 50 to 55% of all new auto sales are electric vehicles. And when you include the hybrids in that number, it's closer to 75 to 80%. And so you're seeing the European market in particular moving very rapidly. What you didn't have 2 or 3 years ago was the buy-in from the traditional auto OEMs. So if you think about the global manufacturers globally, they were just starting to scratch the surface around electric vehicles. And I think they've realized that the modular development of being able to put these autos together in the format that they do with electric vehicles, as well as the cost reduction we've seen on battery technology, has line of sight likely over the next 5 to 6 years to where battery vehicles essentially on an unsubsidized basis reach ICE parity. And when that occurs, you're going to have the combination of policy meeting economics and meeting kind of the desire from a consumer perspective to really accelerate that adoption. Now, that sounds, I think, scary from a high level standpoint, but the one thing that I would want to mention here is the auto fleet is very interesting from a global standpoint. So you have globally about 1.3 to 1.4 billion vehicles in use. That's cars, trucks, heavy vehicles, et cetera. Fleet turnover takes about 10 to 15 years, depending on which market you look at. And if you look into 2019, electric vehicles represented less than 1% of the share of vehicles in use. So even though you're going to see this massive acceleration and adoption of EV vehicles over the next 5 years, the real inflection point for gasoline, which is going to be the first commodity that gets hit, which represents about 25% of your crude stack, is towards the back end of this decade. And I think that's where you start to have a concern is as gasoline demand starts to peak, you start to create some headwinds for structural crude demand growth. Diesel's going to take longer. We don't really have good solutions yet for long-haul trucking, for farming, for construction. And so that's going to be some combination of battery technology, hydrogen, or other opportunities. So I think I kind of our punchline at TPH so far, and we're working through a lot of this right now. Our punchline so far is the next 5 years, we're fairly optimistic on demand. I think the market is overestimating the near-term implications from supply-demand, but we have to be aware of the changes that are on the horizon. And as we get to the back end of the decade, that's where things start to become more interesting. And I know Mark does a lot on this, so maybe I'll turn it over to Mark.
Mark, go ahead.
Wow. Well, I mean, I think all of that makes great sense, Matt. I mean, it's I think to me one of the key questions is scalability. Ken can speak more to it, but we have an initiative at the Institute to look at the minerals that go into the energy transition, and just what's involved in producing enough of the base metals needed to make the batteries for 1.3 billion vehicles around the world, when today there's between 5 and 10 million EVs on the road. That's total, not new sales. So I think one of the really nice questions is, how do we scale up the whole infrastructure around it? How do we deal with the recycling and the shifts it would mean for the power load? How does it mean for energy security? I've got a paper on the Institute's website talking about energy security dimensions of this transition. How do geopolitics shift because of it? And so I think that there's a lot of work that needs to be done. In addition to the base economics of this, to really understand and get ourselves ready for this transition in all of its dimensions.
Yeah. So just to add to that, because we're about up against it on time. We do have, as Mark just referenced, a couple of initiatives ongoing here, led by Michelle Fawcett, Rachel Meidel, looking at the energy and minerals dimensions of the energy transition, as well as waste recycling and disposal, sort of circular economy issues of the energy transition. And these are massively important issues to understand. And I can promise you, because I do see quite a few questions coming through on hydrogen, on, what do you do with batteries, all these kinds of things at end of life. there's a lot of work to be done on that front, and we will be having webinars coming up on those issues. So, stay tuned. This is an active space, and I don't think anybody's going to have a definitive answer in the next 6 months. That's kind of funny to say when you look back over what's happened over the last 6 months and think 2020 has sort of gone very quickly, but dragged on at the same time. But as we go forward, this is going to be an active space for discussion and research and development. And I can almost guarantee that 5 years from now, there'll be something else that catches our eye and ultimately we're asking questions about. That's the one thing that's always true in the energy space. If we didn't get to your questions, I apologize. If you have something that's really burning, feel free to send an email. Happy to try to respond in that way as well. But Mark, Matt, I want to thank both of you for joining us today. Fantastic job. And to everybody on the line, thanks for joining us. Stay safe, stay healthy, and we'll see you next week.